Hey Johnny, check it out. I just got approved for financing on a new house. I got me some new credit cards so I wouldn't have to spend my down payment money on furniture.
What? That's the worst thing you can do when you're starting the loan process, right, Brad?
Exactly. Making a big purchase or applying for new credit during the process can raise your rate, or worse, your loan will be denied by the underwriter.
Whoa. With mortgage rates being so low for so long, a lot of homeowners have been thinking or talking about refinancing their home. And since I just did this, I may be just thinking about it for a long time.
Obviously, this episode is about refinancing your mortgage. That's why Brad is here.
Yeah, hey, thanks for telling me we had a guest today, by the way.
You know, there's a lot of pros and cons to refinancing. So today we hope to give you enough information so that you know if it's the right time for you.
It could make sense to refinance a home when it will save you money or make paying your monthly bills easier.
Some experts say you should only refinance when you can lower your interest rate, shorten your loan term, or both.
But that advice isn't always correct. Some homeowners may need the short-term relief of a lower monthly payment, even if it means starting over with a new 30-year loan.
Refinancing can also help you access the equity in your home or get rid of an FHA loan and its monthly mortgage insurance premiums. Let's start basics though.
How refinancing works. When you refinance, you get a new mortgage to pay off your existing mortgage.
It's the same process as initially getting a mortgage to buy a house, but without the stress of looking for empty cardboard boxes.
And asking people to help you move.
Especially the guy with the pickup truck. And there's less pressure to close by a certain date. Currently, the average time to close on the loan ranges from 5 to 7 weeks.
Yes, and if some type of extenuating circumstances occur, you have until midnight of the third business day after closing to cancel the transaction.
When it makes sense, refinancing can lower your monthly mortgage payment by reducing your interest rate or increasing your loan term.
It can also lower your long-term interest costs through a lower mortgage rate, shorter term, or both.
Also, guys, if your loan-to-value ratio meets guidelines, it could lower the private mortgage insurance, often referred to as PMI. That saves you too. Then we have to consider closing costs.
Closing costs include the origination, appraisal, title insurance, and credit report fees, and are always an important factor in deciding whether to refinance.
These costs typically amount to 2 to 6% of the amount you'll be borrowing. You'll need to know your closing costs to calculate your break-even point.
Love that movie. Whoa, I'm an FBI agent.
Wait, your Point Break reference? Is he always like this?
You'll get used to it. Anyways, the break-even point is when your savings from a lower interest rate exceeds your closing costs. You can calculate this point by dividing your closing costs by the monthly savings from your new payment. Breaking even at 25 months is good. 50 is okay, but 75 months is too long because you'll most likely move, sell, or refinance within the next 6 years.
If you think your new loan will be your last, make sure to account for any additional years of interest you will be paying. That extends your break-even point.
Before we're out, let's run down some common reasons for a mortgage refinance.
Grabbing a lower interest rate. When market interest rates drop, refinancing to get a lower interest rate can lower your monthly payment, lower your total interest payments, or both.
A higher credit score will get you better interest rates. To get the best rates, you need a credit score of a 750 or higher. Last year, the average FICO score was a 763.
Refinancing to access your home's equity. In the first quarter of 2020, 42% of all refis involved an increased principal balance by at least 5%, indicating the owners took cash out, finance closing costs, or both. While cash out refi rates can be a bit higher than rate and term refinance rates, there still may be no cheaper way to borrow money.
Refinancing to shorten your term. If you refinance from a 30-year to a 15-year mortgage, your monthly payment will often increase, but will save you thousands in interest. Interest rates on a 15-year mortgage will shave your years off your mortgage, and you'll pay less interest over time.
That being said, with mortgage interest rates so low, some people prefer to spend more years paying off their home so they have more cash to invest at a higher rate and more years for their investment earnings to compound.
Refinancing to get rid of an FHA loan. FHA loans have mortgage insurance premiums that cost borrowers $800 to $1,050 per year for every $100,000 borrowed. Unless you put down more than 10%, you must pay these premiums for the life of the loan, which means the only way to get rid of them is to get a new loan that isn't backed by the FHA.
Refinancing to get rid of PMI. Eliminating private mortgage insurance on a conventional loan is not by itself a reason to refinance. Unlike FHA mortgage insurance premiums, you don't have to get rid of your loan to get rid of the PMI. You can request cancellation once you have enough equity, typically 20%.
Don't just look at the monthly payment though. Look at how much each loan will cost you in total interest, assuming you pay off the mortgage and don't sell your home or refinance again. To find the best refinance rates, you'll have to do some work, but it won't take much time. Look at banks, credit unions, and online comparison sites.
You can also work with the mortgage lender if you want someone to do the legwork for you and potentially get you access to lenders you wouldn't find on your own.
Or, and hear me out on this, you could call us here at FNBO.
Treat you guys to lunch?
You would never learn, huh?
Cornell, have you ever heard of that?
They're busy, so they'll see you next time on the Dollar Bills.